Welcome to the Leadership Huddle on Deal Structures and Alignment of Interest During a Pandemic, a case study with an operator, a lender, and an equity provider. I'm Brian Puckett with BOK Financial, and we're pleased to sponsor today's Leadership Huddle. BOK Financial is a top 30 U.S.-based bank with more than 20 years of experience in senior housing and care. We provide customized financial solutions designed for owners and operators of post-acute properties, primarily skilled nursing and senior housing. We also maintained our commitment during the pandemic, posting a record year for new loans closed in 2020, as well as a substantial volume of PPP loans. Visit bokfinancial.com/healthcare to learn more. Thank you and enjoy today's webinar.
Thank you, Brian, and thank you, BOK Financial, for your support of NIC's mission. Welcome to today's NIC Leadership Huddle, Deal Structures and Alignment of Interests During a Pandemic, a case study with an operator, lender, and equity provider. This is the fourth Leadership Huddle in our 2021 webinar series. I'm Chuck Harry, NIC's Chief Operating Officer, and I have just a couple quick introductory comments ahead of our panel's discussion. If you need to adjust your audio for today's webinar, you have joined the webinar using either your computer speaker system or your phone based on your audio access during your most recent GoToWebinar session. You can adjust your audio access to today's webinar through either your computer speakers or your phone using the settings in the audio pane, which is located on the top of the control panel on the right side of your browser window. With that, it's my pleasure to introduce my colleague and moderator of today's webinar, NIC's Chief Economist and Director of Outreach, Beth Mace.
Hello, everyone, and welcome. Glad you could join us today. I'm thrilled to be able to moderate a conversation today between three folks I know pretty well: Trace Wilson, who's from PGIM, Brian Sunday, who I worked with for a long time at AEW Capital Management, and Bill Pettit, who, of course, is the president of RD Merrill Company, the owner of Merrill Gardens. So we're going to be talking today about a deal that they did during the pandemic. How did it happen? What were their challenges of getting it done? And a whole host of questions related to that. So I'd like to start, though, by letting both Bill, Brian, and Trace just give a little bit of introduction about themselves. So starting with you, Bill.
Thank you, Beth. I'm Bill Pettit, as Beth mentioned. I'm the president of RD Merrill Company, and I had the privilege of starting Merrill Gardens 29 years ago. And over the years, we've had a great relationship with a number of you, and we appreciate the opportunity to be here to talk about what was a big transaction for us, and also an interesting transaction for the pandemic year that we had in 2020.
Great, thanks, Bill. Brian?
Yeah, thanks, Beth. Bill. My name is Brian Sunday. I'm a managing director at AEW Capital Management, which is an institutional real estate advisor. My primary role is the portfolio manager of our senior housing fund series, of which we have 3 active funds and north of $3 billion under management right now. And just to kind of second Bill's comment, this was a very unique transaction. Kept us busy during a tough time, but it was ended up being a great deal, and we're excited to talk about it with everybody.
Great, thanks, Brian. And Trace?
Great, yeah, thanks, Beth. Thanks for asking me to be a part of it. My name is Trace Wilson. I'm based in Atlanta. Me and my team handle senior housing nationally for us on the balance sheet, and we're also agency lenders with Fannie Mae and Freddie Mac. So, like I said, and like Bill and Brian said, great transaction, and thanks for asking me to be a part of it.
Sure, thanks for being here. So, Bill, let's start with you. Can you describe this transaction, sort of give us a big picture? What was the motivation for the deal, the size of the deal, any kind of portfolio description, just to place us in the conversation?
Sure. Many of you who know us understand that we're pretty active developers and operators of senior housing. And over the years, we really only have developed properties that we want to own very long term. And by that, I mean decades in that context. And so in 2010, we formed, I think, one of the first RIDEA ventures with Healthcare REIT, what was then Healthcare REIT at the time, now Welltower. And we placed 10 core properties for us into that Rodeo venture. And then about early 2019, Welltower came to us and said that they were interested in probably creating liquidity is the best way to determine it in our Rodeo venture. And so we had a good discussion with them, told them that we would support their interest in finding liquidity for their 80% of the venture, but that we were not interested in liquidating or creating liquidity out of our 20%. And so that triggered a search, and Ryan McMahon helped us a lot in terms of navigating that process, which wound up with Brian Sunday and AEW and Trace's help in a very successful transaction.
Great. So Brian, this deal closed in mid-September. That was when the pandemic was top of mind for everyone. So how did you get comfortable with the timing of this transaction? And what was it like when you brought this to investment committee?
All very good questions. I think taking, a step back, Beth, looking at kind of what our strategies in our senior housing funds have been, it's kind of a two-pronged approach where, we do a portion of ground up development to kind of get some, higher returns for the higher risk. And then, our goal is to kind of really buy core cash flowing stabilized assets, obviously with strong operator partners who we have, really good relationships with. Pre-pandemic, as we were putting the money out, and this isn't this was our third fund at the time. It was very difficult for us to really price out these kind of stabilized deals we're pricing where to kind of hit to our fund level returns. And so fast forward to when the pandemic hit, we were in the market raising our fourth fund. And this is a portfolio we were tracking for some time. I think Bill was 2016 or 17 where we did our first transaction, and we did about 3 or 4 since. And so when this deal came to us in June, we said, yeah, of course, this is something we'd be interested in. What's the pricing look like? And so when we kind of went through our underwriting and kind of looked at the pricing, we said, this could make sense. And so, to your question about how did we get comfortable? Well, it's really we have a good relationship with Bill and Merrill. And so we work with them really to kind of look and forecast what the cash flows look like over the next, call it 12, 24, 36 months. And, they, Bill and his team assumed that we were kind of coming out of the, call it, first COVID wave and into an unknown time. And was there going to be a second wave? Was there not? And Bill's team had put together a great analysis of what it would look like if there was or if there wasn't, and different sensitivities. And so we were able to kind of use that analysis to really kind of get comfortable with the cash flow over the next 12 months. And then following that, we all assumed, or knock on wood, as everyone on this panel and on this call are hoping now that once we get through kind of this vaccination period, that senior housing would come back over time. And so that's kind of how we looked at the deal from an underwriting perspective. And we brought it to our committee. Our committee had a lot of questions, and the questions were, well, what does senior housing look like now? What does it look like in the future? And I guess the answer I had to that question was, like, if you look at this portfolio pre-COVID and the performance, this portfolio was 95% leased for 3, 4, 5, 6 years, so probably longer. But if you can, if you want to chime in, and had great NOI growth. And to me was, senior housing is still going to come back after this. But if this portfolio doesn't come back, then senior housing sector in general is going to be in a lot of trouble. And I think that got people comfortable here that, we still do believe in senior housing, during September, during that time, or June or July when we were doing the deal. And that this portfolio, with its past performance, with the operator, the locations, if this one doesn't come back, then we're in bigger trouble here as a sector. So I don't want, it's kind of blunt, but that's kind of how we looked at it.
Beth, I think
you're on mute. You're on mute.
Of course. So It's a famous phrase of this year, right? You're on mute. So what about the markets? Any concerns about the markets? Are they great markets, or did that help shape positively or negatively your view on the deal?
Yeah, I mean, listen, this is all on the West Coast. Half the portfolio is in California, half is in the Seattle area, and one in Nevada. And yeah, I mean, for us, our current portfolio, our West Coast, or called Pacific portfolio, is performing the best over the last 3 to 5 years. And why is that? I think a lot of it's obviously the barriers to entry on the West Coast are a lot harder than a lot of parts of the country. And so when you looked at the markets, you looked at the health in the markets, and for us, really looked at what the supply pipeline looked from even recent deliveries to deliveries in the future. It got us really comfortable that we weren't going to be competing with a lot of newly opened product and a lot of product coming online over the next, call it, 12 to 24 months. So these markets really gave us the comfort to really kind of move forward here.
And last question before I move to Trace, how did your return expectations, projected returns, vary from when the deal closed to what you would have thought pre-COVID? Did you change the return expectations at all because of COVID?
Yeah. I mean, obviously, the hardest part about this deal is we were underwriting an NOI that was decreasing. It's never easy to do, knowing that each month prior to closing, the NOI is going down. Now we underwrote that, but still seeing it it's difficult. And so we knew NOI was going to dip 20-30% to where it was pre-COVID. And so we wanted a little bit higher return expectations for taking that risk for coming back. And so we were able to pencil that based on the pricing. And it's kind of going into your next question with Trace, but really the linchpin that really got us over here was the debt. Without the debt, this thing was dead on arrival. And so based on proceeds and spread, and obviously, as we all know, interest rates shot down to basically zero, and where we were able to lock rate really helped us kind of bridge the gap of the negative kind of NOI drop to we rebound to really kind of make up for that kind of increase in returns that we wanted to get.
Got it. Okay, Trace. So how did you come in and help get the deal closed then?
Very nice of Brian to say, we can't lend money without good partners. So thank you very much for the nice words. There were obviously a lot of eyes on this transaction, as there should be in an environment like this. I'll echo the same things that Brian said, relative to the level of comfort with the portfolio. I think the starting place for the conversation on our side wasn't if the NOI gets back, it's when, right? And that's obviously a much healthier place to start from. When you're having these conversations, we have experience in these markets. We had seen the assets previously, so there was a level of comfort there. So we didn't have the logistical issues. We could speak to the quality. We could speak to the markets, that kind of things with conviction. And again, the conversation was when the NOI recovers, not if, right? And I will say that had this transaction happened now, a lot of those questions would have been a whole lot easier with what we know about vaccines and things like that. So I wouldn't say that that the process was different. I would just say that there were more eyes on it. And like Brian said, you're underwriting an NOI that's going down, right? The difference between Brian and I is that our return was going to stay constant one way or another. It was more of a question: can you live with what you expect to be relatively choppy NOI performance for the next 12, 18, 24 months? And once the answer was yes, everybody was very comfortable moving forward.
So what additional analysis did you do to get comfortable with the deal and the perceived risks? Merrill and AEW from the beginning were very open. We were asking the same questions that Brian was, that Brian and his team were. A lot of scenarios around not only rents but occupancy, expenses. Obviously at that time, there were a lot of unknowns. Even from we're having these same conversations in other asset classes, right? What are the long-term implications from an expense perspective? Do these expenses stay? Do they go away? Are there savings other places? All of those things. So I would probably just say a lot more sensitivity around potential options and where do you land on those?
and where we landed was obviously a favorable spot. But again, I think it goes back to the performance of the portfolio beforehand and the confidence in Merrill to be able to do what they said they were going to do, and a lot of sensitivity.
So what was the LTV in this deal?
It was 65% of purchase price.
And would that have been different pre-COVID?
You know what? I don't think so. Going back to what I said beforehand, if the answer is yes, and you're willing to live with what we all understand to be a relatively choppy time, it wouldn't really have affected us in that regard, right? I think it goes back to the conviction that you have and starting the conversation when it gets back and not if. So I don't think it really would have changed one way or another, up or down.
So Bill, Brian mentions a process of stress testing that you were doing with your properties, and that helped in underwriting the deals from AW's point of view and from PGIM's. So can you explain a little bit of that, what you did for stress testing?
Sure. It's something that typically we have done as owner-operators over the different recessions, as well as now a pandemic. And essentially, when March hit, and for all intents and purposes, buildings were shuttered to new move-ins, to tours, really with restrictions applied by states as well as our own restrictions. One of the things we really wanted to understand, since we own 20% of these assets, was how much liquidity could we have to generate in order to support these assets under this scenario of COVID. And so we took, as Brian mentioned, even before we started talking with Brian about this, we had gone back into the portfolio. We modeled assumptions on how long would be shut with significant restrictions. We modeled what we believed kind of a severe impact would be in terms of move-ins and move-outs. And we projected it out through into 2022. And then we took a step back, looked at that, and then decided to go back in and assume that COVID would result in a second wave of infections similar to the Spanish flu in the early 1900s. And how would that then further impact the portfolio? So we went through and were very transparent with Welltower, then our partner, and then with respect to Brian and AEW and Trace, with respect to their potential involvement. And we went through and we looked at and disclosed to them how impactful that would be on NOI and cash flows. And then we've carried that modeling forward. Obviously, we were hopeful that we wouldn't hit a second wave, but we did. And so we had anticipated that. I'm pleased to say that our projections were worst case, and that we have beat those projections through the second wave.
That's good.
Yeah, and so I thought it was particularly helpful to everybody to understand how we, as a significant owner as well as the operator, looked at this.
So, Bill, Merrill was involved in the first RIDEA venture completed with the publicly traded REIT, which was Healthcare REIT, which is now Welltower. Since this transaction last summer with AEW involved these assets, do you still consider RIDEA structures a viable source of capital for you?
Absolutely. I think one of the really interesting elements of this, as a side element to the actual execution of the transaction, was that Welltower, inheriting the RIDEA structure as it transitioned strategy, was able to find full liquidity for their 80% interest in the venture. We took comfort in that we had entered that venture with Healthcare REIT in the sense that it was going to be a very long partnership between Healthcare REIT and Merrill Gardens. We took comfort in the fact that the RIDEA structure had an avenue to finding a new partner like AEW in this as strategy shifted, and it kind of reinforced our sense of the value, number one, of core investing, and number two, the value of being a partner with a significant equity interest in these assets. And so we will consider Rodeo Ventures in the future, but are very, very comfortable with a more traditional institutional partner like AEW in these assets now.
I think that was the second idea structure that Welltower unwound, at least some of it. I think the first was Benchmark.
Yeah, I think it just reflects, what you normally expect from a large REIT, and that is over time, their focus on strategy might change and shift. I think Welltower still has a commitment to Rodeo structures. I think they just saw this one as one that could offer them some liquidity at high values. Certainly that was what drove a lot of their interest at this point.
Okay, so we always talk about alignment of interest between partners. So what's the alignment of interest here? And this is open to any one of you guys.
I'll give Bill a break. I think, for our point of view in this sector and in the deals we've done in the past, I believe it's close to like 95% of our deals have been joint venture deals. And why? You hit on the head, Beth. It's alignment of interest. Obviously, when an operator has, skin in the game, they have that ownership mentality. Just, for us and for our investors, it just feels like a better alignment. Not saying that a third party doesn't treat their operations differently than somebody who has invested capital in the assets, but just for us, it just, it helps us, get deals, over a goal line. And since our first deal with Bill and Merrill, there's always been a great alignment of interest. They're always willing to put significant dollars into our joint ventures. And, having that commitment, especially in a market, in an environment that we did here to get this deal closed, was very important for our committee to see that alignment of interest and see, they're putting significant dollars into this venture going forward. And so again, it's more of a seal of approval saying we really believe in these deals, and just kind of helps us, whenever there's a little bit of doubt, when your partner is willing to, to show that, alignment of interest, it just really helps us get deals approved internally through our committee.
Beth, from our perspective, and then Trace may want to weigh in, I think alignment of interest for us is the number one objective we have with finding any partner, because this industry is complex. And from an operator's perspective, like with AEW or like with PGIM, the experience and willingness to work jointly with the operator to achieve the best result with the asset is really critical. And the one thing that we have learned over time with AEW in terms of our prior investments is that was a very comfortable relationship. We looked at things the same. We understood kind of near-term and long-term objectives. We came at challenges in much the same way, looking for solutions, not just looking to an agreement, but looking for what was right for the asset and right for our investment first and foremost. And the same thing's true with the lender, because obviously if you're going to do a deal in the middle of a pandemic, you really want both an equity partner as well as a lender that not only believes in the asset but believes in you as an operator. And so we seek out and then continue to focus on doing business with partners like PGIM and AEW.
So what happened? So Merrill Gardens and AEW and PGIM, you've had long-term relationships. You guys know each other. You see each other at NIC conferences, among other things. Plug for NIC conference. But what happens if you don't have a long-standing relationship? How do you start a relationship in the beginning of the pandemic? Or if you don't have a contact or a relationship, you just have to wait until things get better and you have better properties to sell or to buy?
It's a great question. I think that's why I haven't seen a lot of deal flow get done. But I think pre-pandemic, Beth, how we've always kind of looked at new relationships is, we really like to really know the group even before we're looking at, a real estate transaction or entering in a transaction. We really like to understand, the operator or the developer or the virtual team, between the two, just as kind of Bill alluded to, like, what are your goals? What are your company goals? What is your model? What are your growth plans? We're a closed-ended fund, right? We have, we're looking 5 to 7 years and we need to exit. Does that fit yours? And so really making sure that there's a good fit between both groups, right? Not all capital matches up great with every operator and vice versa. And so, again, a lot of this happens over time where you're seeing people at the NIC conferences, and even though you might not do a deal, you're starting to build on that relationship. Bill is, my ex or my late partner, and Chris, he said he was working you over for 15 years before he got a deal done. So, it takes time. And obviously, if you're just meeting someone the first time during COVID with travel restrictions, it's difficult to get that level of trust, right? In order to do a deal, especially in a time like this where, we couldn't even tour the buildings, physically, we had to do it virtually. You need that level of trust. And that trust happens over time. And so obviously now it's a difficult environment to really start those new relationships. And, even for us, we've looked at some deals with new partners that were moving too fast where we couldn't move that fast. And I think that's a little bit of an issue on getting kind of deals, done or new relationships started right now.
How about Trace from a lender point of view?
Yeah, I agree with a lot of what Brian said. One thing that that we're able to do on the debt side that you're admittedly not able to do on the capital side is maybe piggyback off of some of the work that the capital side has done, right? So in a scenario, right, where maybe Brian, in this exact scenario, this wasn't the case for this deal, but Brian had known Bill for a long time. AEW had experience with Merrill Gardens. We could help leverage that based off of our trust of AEW, right, in that relationship. So, I have seen things like that get done. So people, can use, can piggyback off of existing relationships. But in general, I would agree. As a lender, you want to know the same things, right? You want to know that in general you're seeing the world the same way. You want to understand, growth prospects. You want to understand what markets they're interested in, all this other type of stuff. And it's tough to do that, over Zoom sometimes, right? And in particular, it's tough to get a feeling of buildings, right? Which is obviously important. So not to say that it can't get done, but it's obviously a challenge.
So what's your, oh, sorry, go ahead, Bill.
Yeah, I would just offer from an operator's perspective, I think one of the first keys is you got to cross your fingers and hope that you've got a good story to tell and that you have receptive ears from the standpoint of both the debt and the equity side. I think we're fortunate and we understand that. Our objective is to own a material part of the equity. I think that gives comfort to both the equity side and the debt side, that you've got an operator who is as much interested or devoted to ensuring that these assets get well managed during the pandemic as you are, as an equity holder, another equity holder, or debt source. On top of that, I think we were able to help achieve this transaction by moving, as a result of our stress testing of the portfolio, we moved to put $100 million worth of liquidity into our balance sheet so that they had the comfort, both the debt source and the equity source, that we were going to be there to support these assets with them should we need it in the future. And that's something that we know we're lucky because not every operator can do that.
So thanks for those comments. So Trace, I have a question for you in terms of your view of the near-term future. When do you think we'll get back to, a more normal conditions or pre-pandemic occupancy or the level of acquisitions that we're used to? What's your crystal ball tell you?
Back to the first question. committee, what questions were we answering in committee, and what, that was probably the #1 question. And I wish then that we were at where we're at now, just with vaccines and vaccination rates, knowing what we know. And my answer then was the same. It is now. Once we get back to a normalized level of operations, it's still going to take time. And I think different assets are going to perform differently. But and I'm basing this off of conversations with operators and capital that are smarter than me too. Probably 18 to 24 months to get back to a level of NOI, Beth. And that's some combination of occupancy recovery and rent growth and some normalization of expenses. The one thing I do know is, however we modeled it, it's not exactly how it's going to happen. This portfolio was a good example of what works well for us, PGIM. Diversity, diverse markets, relatively low leverage, all that kind of stuff. But what I can promise you is that exactly how we modeled it isn't how it's going to happen, right?
It never does. I've been doing forecasting my whole life.
It never does, and I'm totally fine with that. I just know that going. I just know that going in. So.
Okay. All right. So that's roughly first quarter 23. Brian, first quarter 23.
Yeah, I think it's hard to really look kind of nationally and make that kind of comment, right? There's going to be markets, and some assets and some markets have already come back, right? It's the markets that were struggling pre-COVID, that had supply issues, that were weak in the fundamentals. Those are going to take a lot longer versus, in markets that, did not have the same type of issues, right? On our last monthly call on this portfolio, I'm music to our ears that, they said 3 of the assets in the portfolio were on a race to get to 100% occupied, by the end of April. The first one wins.
Really?
Yeah. So that, those are strong markets, right? But then in other, in the markets that are struggling, it's going to take a lot longer. And so, I think it's going to be, a tale of kind of, two worlds, unfortunately. The stronger markets are going to come back quickly, and the other ones are going to come back a lot longer. And how long are the struggling, markets going to take? I don't know. Some of those markets are down into the 70% occupancy. That's a lot of years to absorb. And, with more delivery, don't forget, deliveries are still coming online. Doesn't mean their starts are happening, but deliveries are still happening. And so it's hard to, to me, looking at it, it's really hard to say the market's going to come back in 18 to 24. I just think it's going to be so, it's going to be so segmented on where the actual properties are located.
And Bill, just briefly, because I have one other thing I want to do here.
Yeah, I think our view has shifted a little bit. The more we've gotten into the pandemic and what is driving move-ins and what is keeping people on the sidelines, because nobody's lost confidence that we talk to. Nobody's lost confidence on the benefits of living in a senior housing community to an elderly U.S. senior. But what they don't know is, and what they've been struggling to reconcile, is what is their life like when they move into a community today. And that is what vaccines and the efficacy of these vaccines is beginning to address. If I'm a senior, I have my own bubble. I see my grandkids. If 6 months ago, if I were to move into a Merrill Gardens community, I would have been told that you can move in. We're going to have you isolate in your apartment for 2 weeks, and you can't see your family. You can't go out when you want. So those are all things which the vaccines are beginning to open up and address. And so I'm more optimistic now than I was 6 months ago about how we might recover. So.
Okay, so we have a guest to join us now who also worked on this deal, Ryan McConaughey, and he's from Newmark, and he was involved actually in recapping and raising the debt for this deal. So Nikki, can you bring Ryan into the screen?
Hi, Ryan.
well,
You're self-muted, so if you just want to unmute your line, Ryan.
okay, well, if you can join us, that would be great. Give it one more minute. Otherwise, I have more questions for this group.
This is the quietest I've ever heard, Ryan.
Okay, so well, we still have time, Ryan, when you join us. But Brian, so you spent a lot of time in investment committee talking about the sort of investment case for seniors housing. Has that changed because of the pandemic? Has the investment case changed?
No, I don't think, our overall view on senior housing, again, long term, I think, with demographics, with the supply, supply starts shut down. I think it's, senior housing as a good long-term view. And as Bill says, the biggest thing was confidence lost throughout this pandemic. And I believe with Bill, I don't think the answer is yes. I think it's just, as things open up, we'll see that confidence come back. I will say our strategy, like I said in the beginning, is a mix between development and buying cash flowing deals. And again, as pricing, back in 17, 18, 19 was getting really aggressive, we focused more on development to try to get to our returns. I think now there is going to be some good buying opportunities. I'm not saying it's going to be distressed, but buying opportunities where, even if you're 5% off where it was pre-COVID, that makes a big difference in your overall returns. And so where our third fund, where we did more 50% development, I think in our fourth fund here, it's going to be a lot more towards acquisitions, because I think we're going to be able to buy deals and pencil into our returns a lot easier, or with assumptions we feel a lot more comfortable with than we did pre-COVID. So that's the only thing that's really changing for our point of view right now. And it's TBD with not enough deal flow. It's really hard to know what the pricing will look like, but that's kind of what we're focusing on right now.
Okay. So I want to be mindful of time, and I wish we had longer time because you guys are great and there's tons of information and questions I have for you. But we only have a few minutes left. So is there something you want to wrap up with? So starting with you, Trace, is there anything that you'd like to talk to our audience about that we haven't had a chance to talk about yet?
No, like I said, I think that this transaction, looking back at the history, the quality of the assets, the alignment of interest that that we spent a lot of time on, which I think was important to a deal of this size in a pandemic. I think it would have been a little bit easier today than it was then, just with some of what were unknowns are starting to slowly become a little bit more clear. But overall, like I said, thanks for having me. Enjoyed catching up with everybody.
Bill?
I would offer that over the last 3 decades in this industry, every time we've had a major recession or a breach of confidence in the industry, we've seen an opportunity for the industry to rebound, but also for an opportunity for investors to make more money. And I believe investors will make more money in this industry in the next decade than they have in the last. And I think it's getting past your focus on the issue. We've got potential solutions. Now it's focus on, as Brian pointed out, where is the opportunity to structure profits as we come out of this? And I think the industry has a great long run ahead of it, and we're excited to be a part of it. So thank you, Beth.
Yeah, and Brian?
Yeah, I just add. I mean, again, this transaction was it was fun, it was hard, it was difficult, and a lot of things need to come together. I will add that the fourth missing piece here is we did need a cooperative seller here, and we had one, and that played a very important role in getting this deal done, because the typical timing of a transaction of when you signed a P&S, when you go hard in closing, that didn't exist in this transaction. Everyone had to come together and understand everyone's point of view and what everyone needed to be able to get that done, and everybody did. And so that was, that's, you said it takes a village to get a deal done. This took a village, and it took everybody working together. And so it was great to see, and I think it will be, proven to be a beneficial, deal for all parties involved. So
Ryan, you're part of the village. You helped make it done. Sorry we didn't connect a minute ago, but we only have a few
All
minutes,
good.
unfortunately. But is there any comments you'd like to make on hearing what Brian and Trace and Bill said in terms of what you folks
No,
did?
I mean, I think like with most transactions, it's all about finding the right widgets to go in the right spots. And fortunately, we had a great relationship to benefit from with not only Bill and Brian from future, or I guess past transactions, but also Trace and Brian. And I think Trace's history with the deal, kind of with the history of these assets prior to AEW's involvement, was a huge catalyst to getting this done. As Brian stated, this wouldn't have happened without the debt, and it wouldn't have happened without Brian and his team having a great relationship with Bill. So it truly was one of those unique opportunities where you find the right I guess round peg to go in the round hole, and fortunately we were able to do it. So we're just really pleased with everybody's execution, and it wasn't an easy time to do it, and everybody stepped up and got it done.
Okay, so let me ask you a question. So this was great because everybody knew each other and there were relationships that had been built. So what if you're sort of don't have a long-term established relationship? How would you go about executing and getting something done?
So I think I don't know that it would have happened, first and foremost, in the timing that we did this transaction. Every one of the larger scale transactions we did during the pandemic kind of beginning until now, especially in that kind of, call it April through September timeline, most of those were just recap transactions where there was an obvious fit on the capital side, there was an obvious fit on the operations side, there were strong relationships on the debt side, which enabled those transactions to happen. I think now the markets have opened up a lot more. There's a lot more availability of capital on the debt side of the equation. The equity has been there. So from that standpoint, it certainly has been easier to find equity than it has been debt this pandemic. And that seems to be getting better by the day. Not only groups like PGIM, but Fannie and Freddie are back open for business in a material way. The debt funds pricing is coming back in. So again, I think we're getting closer to what was a pre-pandemic level, but certainly there's no easy deals right now. We always say that every deal is a snowflake, and certainly every deal is a snowflake in this current.
I hadn't heard that expression, so remember that one. All right, so that's great. So thanks very much, Bill, Trace, Brian, and Ryan for joining us. And Chuck, back over to you.
Thanks for having me.
Beth, Bill, Brian, Trace, and Ryan, thank you for your thorough review of this interesting transaction. We really appreciate your insights on how you actually successfully executed the transaction in the middle of this pandemic. As a few seats remain for the follow-up group discussion to today's leadership huddle, if you're able to join us, you're welcome to click on the Zoom link, which is now posted in this webinar's chat. The Zoom group discussion will begin shortly at 10 minutes before the top of the hour, or 2:50 Eastern, 11:50 Pacific. We welcome everyone to join us again 2 weeks from today on Wednesday, March 24th at 2 p.m. Eastern, 11 a.m. Pacific for our next NIC Leadership Huddle titled Value-Based Care, What's in It for Me? Within the upcoming huddle, 3 operators will share their respective approaches to providing health care and to participating in value-based care models. And commentary will be provided by Amy Kazik, President of Special Needs Plans at Ally Align, and Jim Linear, Vice President of Strive Health. On behalf of the National Investment Center for Seniors Housing and Care, thank you again to BOK Financial for sponsoring today's Leadership Huddle. It's through sponsors such as BOK Financial that, in large part, NIC can provide a forum for education and discussion such as this, and thereby help to enhance transparency, facilitate the efficient flow of capital in seniors housing and skilled nursing, and support access and choice for older adults. This concludes the webinar portion of today's Leadership Huddle.
Okay, so thanks everyone, and hopefully see you over the Zoom.
Great.
All right.
Sounds great. Thanks so much, Beth.
Thanks.